Greetings. My name is Gino Mapetere, and I would like to take you through today through recoupment under the Income Tax Act, Chapter 2306 in Zimbabwe or of Zimbabwe. So basically, the learning outcomes are designed for students that are probably taking a tax examination, and recoupment could be one of the examinable principles. So my learning outcomes for this particular recording is that what is recoupment and what is it not? More often, candidates study, memorize some working, but they don't really get to the bottom of what it is they're dealing with. And we will show you some of the common misunderstandings that can happen in trying to take a principle. And for a candidate that is writing an examination, this can impact on the number of marks that you can score from that principle. We will also try and go through how to compute simple recoupment and also recoupment for deemed disposals. By simple recoupment, I mean a simple disposal. Recoupment for an asset whose cost was limited for capital allowances is also another concept that I would like us to go through. And finally, just to discuss scrapping allowances. Right. So let's try and break apart what recoupment is, and at the same time try and look at what it is not, which means we'll be looking at common pitfalls for in terms of understanding recoupment, whether by students or generally understand the general understanding of recoupment by even non-students, practitioners. So question one, we're working on what it is not. Is recoupment a tax profit? I've seen a lot of literature that suggests that, but I beg to differ. Why? I feel that this would be very misleading. And let me get into why I think so. You see, fundamentally, recoupment arises when you dispose of a capital asset. So when we are doing recoupment in income tax, we are dealing with a gain or an amount from a disposal that is in the first place not income for income tax purposes. It is not included in gross income. So when we are calculating recoupment, the concept there is not to say what profit was made by the disposal of this asset, which is why I feel calling it a tax profit, unless explained, which would be a very complicated explanation, I suppose, differently, unless explained differently, it is misleading to call it a tax profit. Since we're trying to tax income in the income tax, it then makes it as if because we sold an asset, we're looking for the gain, the income, the profit, and that's what we want to tax, which is not the case here. Remember, the asset that has been sold is capital in nature. Once an asset is capital in nature or income is capital in nature, then that income cannot be included in gross income. Therefore, the income tax story stops. However, we'll still need to say, so why are we bringing it into gross income under recoupment? At least we've dealt with what it is not. I feel it is not a tax profit. But there could be other ways of explaining it, which will make it even more complex. However, this tax profit, we then see it in terms of our experience, in terms of marking scripts, where you can tell that the student miscalculated their recoupment because they are viewing recoupment as a profit. Capital gain. Is recoupment a capital gain? Again, no. Once you have disposed of a capital asset, and there could be a difference between what you bought it for and what you've disposed it for, and therefore a gain there. That gain, which is capital in nature, if taxable, will be taxed under capital gains tax. And again, recoupment is not meant to bring back the capital gain into income tax. So recoupment is not the taxation of a capital gain. The inclusion of recoupment in gross income is not akin or equivalent to the taxation of a capital gain. Let's look at this third one. Very interesting. Unfortunately, it has used the words that most of you as candidates are familiar to, but most likely most candidates have never really looked at the impact or the true meaning of these words. Is recoupment the recovery of allowances previously granted? And the answer is yes. Right. So what do we mean by recovery of allowances previously gained? Oops, I think this thing has gone ahead. What it means is you have been granted allowances all along as a taxpayer, and you have now disposed of the asset. So the question is, how much were you given as an allowance? Because if we remove the allowance from your cost, we're coming up to a value that we think is a fair and correct valuation based on income tax rules. But hang on, this value or the income tax value is not the same as what you've disposed of the asset, which means the income tax value is an incorrect estimation of the value. Now we've got an actual value. If the actual value is higher than the income tax value, what does it mean? It means we gave you too many allowances and we would like to recover them or recoup them. So the way we recoup them or recover them is to reverse a deduction that we gave you previously. How can we reverse a deduction previously granted? Put it into gross income, which is why recoupment is put into gross income. It's not about the gain, but it's about the recovery of allowances that were granted, but it turned out, after having the actual valuation at the point of disposal, it turned out that there was an over-granting or an under-granting. Where there was an over-granting, we reverse that, we recover that, we recoup that as a tax person. Where there was under, the taxpayer is requesting for additional allowances, and there are conditions to that. So the next question is, how do you compute simple recoupment? Simple recoupment is computed by, first, there must be a disposal amount or a deemed disposal amount. So X sells a car for $30,000. That amount, that disposal amount is very important. Or X is involved in an accident and the car is written off. However, the insurance pays $30,000. So that's it. Those two are examples. The former is an example of a straightforward disposal, and the latter is an example of a deemed disposal. You haven't really sold it, but you are deemed to have sold it. Other examples of deemed disposals you can look into the Income Tax Act, where you have things like an asset sold by a court order and things like that, in recovery of debt and things, and so on and so on. So you need a disposal. The amount for the disposal sometimes is pretty clear. In my example, I've just told you 30K. But sometimes it's not as clear, because what can happen is X sold a car that they bought for 30,000, but they exchanged for a piece of land, and the land has been valued at 28K. So what are you including as the disposal amount? Is it the value of the asset, which is the land that you're receiving in a barter exchange, or is it what you spent on the car? Or maybe you could be having prices for cars, ballpark prices for such a car, its year, its date. I know Zimra keeps in some system where it says, if this is the model and this is the year it was bought, here is the baseline amount that we expect that value of the car to be. barring obviously any accidents and all those things. Those are now extenuating circumstances. And maybe that value, that commercial value or market value of that car is 22,000. So the question is, what are you including in gross income? Is it the 22K, which is the market? Is it the 28K, which is the value of the land that you received? Is it the 30K, which is used? In this case, you will have to use the value of the item that you are receiving, and therefore you would be including 28,000 in the amount of the disposal. So yes, what do we have? Disposal, and that disposal has to have an amount. The next thing that we need to do is to say, what was the cost? In this case, in our example, the cost of the car was 30K. And so what capital allowances were granted? If this car was claiming SIA and maybe for 2 years, which means it has an ITV of 15K. Once we've determined the ITV, we now compare it to the disposal value. The ITV, 15K. And what's our disposal value? We've just agreed, even if it's let's do the barter transaction, we've agreed on a 28. So 28 compared to the 15. What does it tell us? It tells us that from a tax perspective, we are expecting this car to have a value of 15. And therefore, we've moved from 30 and given you allowances of another 15. Assuming that this is how the value of that vehicle will be progressing in real life. But clearly that estimation is incorrect. We over allowed by 13,000 because the true value is now 28. The actual value is 28. So 28 minus 15, you get your 13,000. That 13,000 is what has to be recouped or recovered and put back into gross income. Let's assume for a minute there that the land has a value of 35,000. What does it mean? Cost 30. Capital allowance is granted 15. Income tax value 15. What do we have in terms of the disposals? 35. So the difference between 35 and 15 is not the recoupment. It is not the recoupment. The moment you say 35 minus 15, you're now calculating a profit. What we are saying is, we started at 30. We expected the car to have a value of 15 at this stage. Clearly, we were wrong because the value is 35. Therefore, what are we reversing? Just 15 and not 20. We're reversing what we gave you. We are recovering what we gave you, but it turns out that we shouldn't have given you. So instead of saying 35 minus 15 and getting a 20, you will simply say, I started at 30, I came to 15, I was wrong. It actually increased value. From 30, we should have been calculating again from 30 to 35. May I reverse what I gave you? So I reverse just 15 and not 20. Were the allowances granted adequate or were they too much or too little? This is what we have just done. So that is how to compute simple recoupment. Were the allowances too much? Yes. That's our story about 28 to 15. And what is the excess? 13. So if the recoupment is a reversal of the excesses, how will we recover? Put it back into gross income. So recoupment is a gross income story. Were they too little? So let's look at a case where they were too little. They can be too little if the disposal proceeds, let's just say, were 12. So what's happening now? We bought a car for 30. We gave it 15 in capital allowances. At the date of disposal, we are estimating that income tax value is estimating that this thing should be having a value of 15. Here, it has a value of 10. So the question now is, did we not give too little allowances? And if that is the case, the taxpayer is coming to the taxman and saying, can I have an additional 5? And we are saying there are conditions for getting that additional 5. And it's about the scrapping. It's called the scrapping allowance, that additional allowance. But what are the conditions? So the scrapping allowance can only happen if the asset is being disposed by way of scrap. It arises, as I've just explained, you have an ITV, you then realize that the disposal is lower, the disposal amount is lower than the ITV. So this gap, you are requesting for additional allowance. We've been given capital allowance all the way down to ITV, but I need more allowances, and I want to call that scrapping allowance. That's how it arises. But it can only be granted if, first of all, there's a decision to scrap, and secondly, you have to understand what is to scrap, sell by way of scrap. So if it's a car, it's when it's taken to a scrapyard, stripped, pressed, and so on. It has to be scrapyard, not a parts dealer who sells car parts. Okay, it has to be scrapyard when it is being scrapped off. And so, what's the significance there? The significance is, if this control is not put, if it becomes automatic that every time someone is disposing and whenever their ITV is higher than the disposal amount, there is a possibility of evasion and avoidance, if I can call it that as well, where the buyer and the seller will always be trying to come up with a disposal amount that is way lower than ITV, so that taxpayers can get additional capital allowances. And that's very significant, because if you do not understand scrapping allowance, you are going to create a tax risk if you try and claim a scrapping allowance without necessarily understanding the conditions of how to claim a scrapping allowance. And what's the risk? The risk is that claim may be disallowed, and you will still have to pay taxes in later periods, sometimes with penalties and interest. So that clawback and that reassessment, or that assessment that causes you to pay taxes later when you had thought you had avoided paying taxes, is a risk on